The elusive strategies on creating wealth don't have to be so elusive after all. One of the main pillars of wealth building is creating flows of income. There are several types of flows of income, but one of the easiest forms of income is something called dividend income. Easier said than done. Dividend income is created by consistent and methodical investing over time that can create substantial recurring income over the long term. But patience is key, along with having the right vehicle and strategies to create wealth and retire early using dividend investing. In this video, I will discuss the different strategies and techniques the wealthy use to build wealth using dividend income, and how you too can create a similar flow by using a simple portfolio outlined in the video. Get ready, you are now entering the Academy. Dividend income is one of the 7 main flows of income millionaires use to create wealth. What are dividends? A dividend is a payment made by a corporation to its shareholders, usually as a distribution of profits. When a corporation earns a profit or surplus, the corporation is able to reinvest the profit in the business and pay a proportion of the profit as a dividend to shareholders, also referred to as dividend income. Not all companies offer dividends. Dividend yield represents the annual return that is expected to be paid out in dividends. So for example, a dividend yield of 3.2% represents an annual return on investment of 3.2%, broken up into either quarterly or monthly payments, usually paid out every 3 months or monthly throughout the year. Although it is taxed as regular income, dividend income can be scaled into a substantial income-producing asset for your personal portfolio. Through careful planning and diligent investment of capital, as well as reinvestment of dividends, one can create a dividend income stream that can produce substantial income, even to cover everyday expenditures. There are several principles that we need to be adhered to in order to become a successful dividend investor. I will now go over each one of these principles. The first principle is value investing, which is an investment tactic where stocks are selected which appear to trade for less than their intrinsic or book values. Value investors actively seek out the stocks they believe the market has undervalued. The key is to buy dividend stocks that are value stocks or are very undervalued. This minimizes risk and maximizes potential returns. And there is also a premium, whereas a dividend company, the investor gets paid a dividend on a recurring basis. So it's a win-win situation for value investors. For more information on value investing, check out the video titled Value Investing for Beginners, The Intelligent Investor, Benjamin Graham. The second principle, dollar cost averaging, is a strategy that allows an investor to buy the same dollar amount of an investment on regular intervals. The purchases occur regardless of the asset's price. As the price of the stock drops, dollar cost averaging allows an investor to purchase more shares at the same dollar amount. And as the price goes up, purchases are for less shares at the same dollar amount. Consistent dollar cost averaging is the key to increasing positions in a portfolio over time, thus increasing the value of an undervalued and underappreciated stock. This formula creates maximum potential for returns and gains, building up a position of a stock while it's undervalued and waiting for it to appreciate to gain big profits. In the meantime, while waiting, a nice dividend is collected from the company. The third principle is dividend reinvestment, which is the process of reinvesting dividends paid out by each stock either back into the same stock or into other underperforming stocks, to dollar cost average your position into that stock or group of stocks. Many companies provide a dividend reinvestment program or dividend reinvestment plan, also known as a DRIP, in which the investor does not receive quarterly dividends directly as cash. Instead, the investor's dividends are directly reinvested in the underlying equity. However, nowadays, with free stock trading apps such as M1 Finance, investors can now purchase and reinvest dividends commission-free, allowing them to reinvest the dividends in more strategic and value-based methods. M1 Finance has an auto reinvest feature for dividends, where an investor can reinvest his dividends into either the same equity that paid out that dividend or other undervalued equities, thus giving them full flexibility and freedom for how they want to invest their cash. Dividend reinvestment is one of the key strategies when talking about the dividend income flow model, as this allows for a compounding effect where a portfolio's value can go up quite significantly versus not reinvesting at all. Applying all of these principles, we can create a dividend portfolio of strictly dividend income producing stocks or funds. A dividend income portfolio is a portfolio consisting of primarily dividend income paying stocks with the goal in mind of diversification and value investing. For more information on how to properly diversify your portfolio, please watch the video titled A Beginner's Guide to Investing in the Stock Market, Creating Passive Income. A simple portfolio that meets all of the criteria mentioned previously is shown here. The portfolio consists solely of ETFs, which are exchange-traded funds for purposes of diversification and risk mitigation. For our portfolio, we have the following: VYM, the Vanguard High Dividend Yield ETF with a dividend yield of 3.2%. VYMI, the Vanguard International High Dividend Yield ETF with a dividend yield of 4.58%. Noble, the ProShares S&P 500 Dividend Aristocrats ETF with a dividend yield of 2.13%. VB, the Vanguard Small Cap ETF with a dividend yield of 1.55%. VO, the Vanguard Mid Cap ETF with a dividend yield of 1.35%. BND, the Vanguard Total Bond Market ETF with a dividend yield of 2.88%. The total dividend yield of the portfolio is 2.62%, assuming the ETFs are equally weighed in the portfolio or each position has a weight of 16.7%. By putting more weight on the higher dividend paying ETFs, such as VYM or VYMI, you can achieve higher dividend yields with a bit more risk involved in the investment. Be sure to click on the link in the description to sign up with M1 Finance so you can use the portfolio above to get started investing in dividend income producing stocks and funds. And if you sign up now, you'll receive $10 which you can use to start investing in this dividend portfolio. By employing the strategies mentioned in this video, which include value investing, dollar cost averaging, dividend reinvestment, and diversification, you can create a low-risk dividend income flow that will appreciate over time and continue to pay income continuously. Through careful planning and diligent investment of capital, as well as reinvestment of dividends, one can create a dividend income stream that can provide substantial income, eventually covering everyday expenditures and beyond. The M1 Finance stock trading app provides a great vehicle which allows for commission-free buying and selling of stocks, thus producing a great way to create and grow a dividend income portfolio using the methods mentioned previously. Be sure to check out the links in the description to get started on creating your very own passive income producing asset and start your path toward financial independence. Thank you for watching this video. If you enjoyed this video, don't forget to hit the like button. And if you haven't done so already, be sure to subscribe to the Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.